Well, welcome to our weekly investment update. My name is Chris Marshall. I'm Head of Investment Strategy here at Dragon Investment Managers. It's Monday the 1st of June and it's really a chance just to look back over last week's trading sessions and look at kind of some of the things which were driving markets, as well as perhaps some of the headlines and events and data points to look for this week and what might affect equity markets and bond markets and financial markets in general. So as we look back to last week, most of the equity markets finished on a pretty good note. Some of the European and UK indices had a couple of down days towards the end of the trading week, but overall still remained up over the week. There wasn't really any particularly strong moves in sovereign bonds. Certainly the US continues to trade in this range, which has been there for several weeks, trading between about 60 bips and 70 bips. And we've also seen a little bit more of positive sentiment come back into the market. So there's a bull-bear ratio market sentiment survey, which is done on a weekly basis, and this is showing that the world is not quite as bearish about equity prices as they were over the past few weeks. And this is really kind of pulling through into, it's on a technical basis, we're seeing some positive signs within equity prices as well. So what's driving all this? Well, really it's the equity markets looking further down the road. We're seeing increases in mobility, that is the movement of people in many locations. We've seen Europe start to ease some of those travel restrictions further. This is in the likes of Greece, also in Denmark and Norway, all announcing things over the past few days where it's just going to allow people to move more freely, which of course is a very big catalyst to getting the economy back on track. It's not to say that everything's in place and it's going to be rapid and very smooth recovery from here. Certainly all eyes are going to be on the unemployment data in the US the end of this week. I think it's the 5th of June that we get to see that print. Remember last time we said that it skyrocketed to 14.7%. If we go back to 2009 and 1982 as two periods of very high unemployment, it peaked around 10%. Still not as high as the unemployment levels we saw in 1933, but still very, very high numbers, and it's thought to increase further to about 19, maybe 19.7%. So people are talking about central bank action, they're talking about potential inflation. These are kind of worries for the further down the road. Right now, inflation doesn't seem to be the problem, although we've got a massively increasing what we'd call adjusted monetary base. That's the amount of money in the system, because we've seen central banks print and inject so much in various forms. We're not seeing that come through in what we'd call velocity. That's the speed that it exchanges hands around the market. And in fact, velocity of money has been falling ever since around 2000, where it's halved in that time. So this isn't a coronavirus thing that money velocity has fallen. It's been a trend for a long time, but we haven't seen that uptick. And until we do, our thesis is that we won't really see hyperinflation or very high inflation until that happens. Now, of course, there are some other things going on. Brexit talks are going to continue this month. There is, of course, the high possibility that all this economic disruption and supply chain disruption kind of gives a little bit more weight to politicians feeling secure in doing a hard Brexit. It might sound counterintuitive, but essentially it would disrupt so much economic activity that, of course, it gives them a little bit of an insurance policy if anything goes wrong, as it's very hard to pinpoint what the effects of coronavirus were and what the effects of Brexit might be. So this is one thing that you maybe see a higher weighting towards a hard Brexit, as they have a little bit of cover in terms of the outcome. Other things which are going on around the world, of course, Hong Kong is very much very topical and very important. Of course, if you go back to the history of that, then there should have been a kind of a one countries and two systems policy in place up until 2047, and the changes in policy which are being pushed through or wanted to be pushed through by the Chinese government It's kind of erode that one country's two systems principle and makes it very much a one country, one system principle. So the geopolitical tensions between certainly the US and China are likely to increase further over this. There is also, and perhaps this is one of the reasons why we saw a bit more of a harder sell-off in the European regions and the equity markets on Friday, is that Angela Merkel came out saying that one of her top priorities was to basically prioritise EU-China relations, which of course could potentially pit the US against Europe, which would increase geopolitical tensions even further. So those are some of the things kind of which we will have to jump over as hurdles in the weeks to come. But for the time being, markets are very much focused on the reopening stories, as they should be, and we are seeing those kind of green shoots come through of people moving around, of businesses starting to get back into business, and long may that continue, and it having its upward pressure on both equity markets and risk assets. So that's kind of really a summary of where we're up to. We will be recording another one of these at the end of this week. Traditionally, we record it on a Friday, so we'll get that out to you then. But for the week ahead, I wish you a very healthy and happy week ahead from myself and all my colleagues at Dragon. Thank you very much.